information. So significant risks that I don't think it really worked through until the very end of this year, the beginning of next year. So it's a little bit more speculative than Amazon and Google. I like Facebook as a stock, but you have to have a 12-month duration in order to buy it.
It's not on our list, but what do you think of Microsoft right now?
I don't cover Microsoft, but it falls in this category of the highest quality tech names. And I think I look at the basket of consumer tech that's out there. I think the highest quality names come back first, and then your pure recovery names. And I think one of the names we also like is Booking, and Expedia would be in that list too, and an Uber. But Booking is a name I particularly like because I think it's high quality, well-tested business model, high PE, high teens PE multiple for what I think is better than market growth. And it's a clear recovery play, assuming travel continues to recover as it was looking like it was going to do prior to the Russian invasion of the Ukraine. If that continues to be the case, then Booking, I think, is a great recovery play and a high quality name. So it's kind of a Venn diagram stock for me.
Okay.
High quality recovery.
Do you have a surprise name for us? Meaning something that's just so beaten down that everyone's just completely disregarded, that you think maybe it's got some risk to it, but if it works, big?
Well, I think of the mega cap names in consumer tech, I think the most contrarian and therefore the name with the most upside surprise, but you got to have 12 months, is Facebook or Meta Platforms. If you're willing to go down cap a little bit, there's some of these names like Spotify that have really been beaten down hard that I think have got interesting gross margin stories in the back half this year going into next year, and I think have consistent subscription businesses. That would be a nice stock with a lot of upside.
Okay, Mark, it's always good to see you. We will be watching these games, as you know. I'll talk to you soon. Thanks.
It is literally just past 7, just seconds past 7 o'clock on the East Coast. We watch the Squawk Box on CNBC. I'm Joe Kernan, along with Andrew Ross Sorkin, and Becky is off today. We've got a big lineup in the next few. Pretty big.
I mean, we've got us.
Well, that's right.
I mean, come on.
And we have those gentlemen coming up. We're going to talk to the founder of Tasty Trade on the recent meme stock run. Those next two gentlemen are going, I don't know if it'll be much of a debate, really. I don't know where Mooch is on these things lately. We hardly knew ye, Anthony. But they're going to talk about Biden's billionaire tax proposals with Ro Khanna. I know where Ro stands, Congressman Ro Khanna and Anthony Scaramucci. And then we're going to get Professor Jeremy Siegel's take on the markets. We call him a permabull. He's decidedly less bullish, thinks the Fed is behind. So we'll see what that means long term for equities.
Talking about equities, take a look at where the Dow sits right about now. We're still about 2.5 hours before the market's set to open, but if we did it right now, we'd be off about 70 points. We were off about 100 points when the show began at 6. NASDAQ off about 66 points. S&P 500 looking to open down about 10 points. I want to go back to Dom Chu, who's been looking at some of this morning's pre-market movers. Dom, what's going on? And guess what? We don't have his microphone.
Audio.
I could do this. I mean, not as well as Dom
Not as well as Dom will.
But we could go through some of the big names.
Technical difficulties. We should fix that easily. Hey, Dom, you ready yet?
We got
I'm
him
here.
back.
Can you hear me now?
There you go.
Can you hear me now?
Can you hear me now? It's like a Verizon commercial.
Or a Sprint commercial. Or I don't know what it is these days. I mean,
was that a Sprint commercial?
Or a T-Mobile commercial these days, right?
Oh, with that actor.
It was the actor, right? That went from Verizon
changed.
to Sprint, and then I guess Sprint is now
Why did they not have a
rolled up.
non-compete on that guy?
Would you sign that guy for a non-compete? You really care if he goes somewhere else? Can't get another guy
Well,
like
think
him?
about it. We're talking about it.
I know.
I mean, he's one of the most recognizable people in telecommunications, right?
We should get a marketing and advertising guy on. I bet after that happened, people are now doing non-competes on those actors. And the question is, I bet that...
Did you notice one of the dope sick lawyers is a big, phone salesman now? Phone salesman.
I guess the comparable person right now is Lily from AT&T, right? Because you see her during the entire NCAA.
Even.
Oh, really?
Yeah, there's a Lily imposter because Lily's at the games apparently, and so they have to bring somebody else in to pretend that they're Lily from AT&T. So anyway.
But we digress. Wow.
We digress. All right, so now that my microphones actually work, I will take you through some of the movers here. We'll start with a couple of positive ones because the overall market narrative right now for the futures is slightly negative. But check out what's happening with Micron. Semiconductors, obviously a very big part of the market, a huge focus for traders, maybe being a leading indicator for that tech trade, the overall market. Micron comes out with earnings after yesterday's closing bell that were both revenues and profits better than expected. It was also the outlook for Micron that actually wowed investors as well. So the forecast looks good. Micron is helped along by other things, but strong data center demand was really big for some of these computer memory chip makers. So Micron, a very big focus there, up about 4% in the pre-market trade. Also Lululemon, because Lulu comes out, athleisure, we know how much Joe likes those pants, right? But not just the pants, but everything else seemed to be doing well. Lululemon comes out with profits that beat expectations. The sales did fall somewhat shy of analysts' forecasts, but again, it was the forecast for full year revenues and full year profits that, again, wowed investors. They also announced a $1 billion stock buyback program. All of those things on balance, by the way, helping Lulu shares up about 8% right now. But remember, this stock also fell roughly 40% from its recent highs to lows during that span. So Lulu, a big focus here as well. By the way, they're going to put selective price increases on some of their products to outweigh some of the costs that they've seen. And then a check on the meme stocks, because I know you folks are going to talk about it later on this hour, maybe even in the next few moments or so. But GameStop and AMC on a year-to-date basis. Remember, these stocks both more than doubled in just the last couple of weeks here. The meme stock frenzy really kind of taken hold again. And by the way, if you're wondering what they're doing right now, they're both probably taking a breather, GameStop and AMC, in the pre-market trade right now, despite the fact that we've seen those massive runs. If you look in the pre-market right now, both of those stocks, GameStop is down just fractionally, about 0.2%. AMC down about 1% as well. So a check on those meme stocks. Big run, guys. Andrew, Joe, I'll send things back over to you.
Okay, at the domino. Thank you, sir.
Don't stop messing with your mic, Dom. It was working fine there. I don't know what you did, but thanks. The health of the nation's labor. I don't think he did anything, did he? Well, probably wasn't his fault.
Probably not.
It's amazing that it works so much. We should be.
It works as well as it does.
Right?
It's a minor miracle.
Yeah, the health of the nation's labor market will be in focus for the rest of the week. The employment report, ADP, is due out in just over an hour at 8:15 Eastern Time. We'll get jobless claims tomorrow. Then on Friday, the March employment report. They're going to put that together quickly. Steve Leisman joins us now with some high-frequency data on how inflation is impacting the job market. You're going to tell us what you think about ADP too, Steve?
Yeah, I'll give you a number anyway as to what people are forecasting, but that's all I can tell you right now because, Joe, it's a tricky call on this jobs report. The high-frequency data shows little growth and even a slight decline from the strong pace of February. Yet there's also not been much obvious impact yet from high inflation or even Fed rate hikes as sectors like leisure and hospitality, they keep bouncing back from the slowdown we had earlier this year from COVID. Dave Gilbertson from the HR software company UKG writes that workforce activity indicated a slight slowdown in job growth as no accelerants brought people off the sidelines into new jobs, and negative effects from high oil prices and the BA2 COVID variant have not yet impacted hourly shift work. Here are the numbers that we're looking for. 450 on ADP. Jobless claims they're low, and that's something that tells you that the job market remains pretty strong. They're expected to be 195 tomorrow, and BLS payroll is supposed to come in at 490,000. The data collectors over at Homebase, they saw a similar trend of slight weakness, but it was based on really a cooling off from the really strong numbers we had in February, and they continued to chronicle a recovery from Omicron. They wrote, quote, as Omicron faded and people sought recreation and amusement outside the home, hours worked by employees increased in entertainment, food, drink, and hospitality, especially hospitality, by the way. So Fed officials, they've expressed concern about a possible wage price spiral. That's where high wages create high prices, which create high wage demand. So as much as everybody wants more job growth, the Fed is hoping for some cooling off of the job market to take pressure off of wage gains and inflation. They might get a little of that this month, Joe.
All right, Steve Leisman, thanks. And they probably have a pretty good idea, right? I was saying March 31st, and the next day they got to have it ready. They have a pretty good idea already, don't they, Steve? I mean, and it could be off by hundreds of thousands anyway, as we know, so they can revise it.
You mean the Fed already knows, or the BLS already knows? Who do you say
I'm saying that
knows?
the BLS to get it that quickly, because usually it's not the very next day. Sometimes they actually...
Yeah, no, you're right.
They'll actually put it off a week, but they aren't this week. We're going to... So will it be less reliable? And you know what day it is.
Right? And you also know it's been really... You know
what the date is?
April 1st, right. Exactly. April 1st. Yeah.
Also, yeah.
But Joe, no fooling. The jobs numbers have been really lousy in terms of on the first print. You know, remember we did 200,000 in November. That was something revised to plus 600,000. That's why we're following this home base and UKG data, which, by the way, I didn't tell you this, but the UKG data has strengthened since the survey period. So they're showing some acceleration. I'm trying to find, Joe, some impact of high oil prices, high inflation, Fed rate hikes in the jobs data. I don't think I'm seeing it yet.
Not yet. Okay. Probably a lag. All right, Steve Leisman, thanks. Coming up, check on the energy sector. We're just referring to it after seeing big losses yesterday. We're going to talk to prices and get a preview of tomorrow's OPEC meeting. Is that tomorrow? Good.
I think so.
That's next.
Welcome back to Squawk Box. Germany now declaring an early warning that it could soon be facing a natural gas emergency as Europe's largest economy preparing for the risk of a full supply disruption from Russia, I should say. Germany's economic minister now calling for consumers and companies to reduce consumption. Joining us right now to discuss that headline in tomorrow's OPEC meeting, Halima Croft is here, head of global commodity strategy at RBC Capital Markets, also a CNBC contributor. Good morning to you. This news from Germany, what does it really mean, and what do you think it really means to the price?
I mean, right now there's concern that the Russians, as you know, have been asked to pay in rubles for gas, and you've had a number of European countries come out and essentially say that they'll be violating their contracts. So there is now this concern about a possible Russian gas disruption into Europe. Now, the big issue in the gas market is there's simply not a lot of additional spare capacity out there to bring new supplies into Europe. So if we do see some type of curtailment in Russian gas exports to Europe, there's not immediate gas on hand to really make up for that.
And therefore, we're looking at right now, by the way, nat gas at $5.33. What does it mean longer term? Not even longer term, short term, week, 2, 3 weeks out if this is the case.
I mean, the big concern is, are we looking at industrial curtailments in Europe? I was just in Qatar, one of these countries that we would look to for additional supplies. And the Qataris were really clear, like, we're essentially maxed out in the near term. And the US is talking about providing additional 15 BCMs into Europe. But again, that's a drop in the bucket in terms of making up for a major Russian supply disruption. So there is real concern about a shortage of gas going into Europe and what that would mean for Europe's economic outlook.
Halima, I have a totally different question. I don't know if you saw earlier in the show, we were talking about this Brett Stevens column this morning. We were talking about what Putin's endgame is. And Brett posits effectively that this whole conflict is actually pre-planned and is actually all about energy. You believe that?
I mean, look, I think that Putin has a broader plan than energy. I think it's about basically reconstituting his sphere of influence. I think what we should be paying attention to is he looks like he's basically trying to rebrand some of his military losses as diplomatic concessions. There's no indication right now that this war is anywhere near an end game. And so I think market participants really have to think about these sanctions that have been placed on Russia being long-term, that we're going to potentially see more disruptions of Russian energy. Amos Hochstein is President Biden's special energy envoy in Dubai this week, said we've already lost 2 million barrels of Russian exports. I think those losses are going to climb. I think this conflict goes on.
And when you say it goes on and is long-term, are you talking about multiple years, decades? What are we talking about here? Because we also were talking earlier in the program about, is there a way for Putin to come effectively back onto the scene in Europe if somehow this all stopped tomorrow, which I don't think it is?
I mean, look, if Vladimir Putin removes his troops tomorrow, I don't see any willingness on the part of Western powers to roll back sanctions after he's caused a massive refugee crisis. 4 million people are now displaced from Ukraine. You have potentially thousands dead in Mariupol. I just don't see this country getting out from under sanctions anytime soon unless there's a change at the top in Russia.
Okay, so if that's right, we're looking at WTI crude on the screen right now at $106, basically, $107 bucks. What does that look like to you come Christmas?
I mean, Andrew, what I think we have to think about is, do Western powers intensify the sanctions pressure? Right now, Russian crude is essentially unpopular because of a buyer strike with banks, shipping companies, and energy companies saying, we won't touch it. But major consumers of Russian crude and gas are still taking the product. The big question is going to be, does Putin do something in terms of escalation that makes Russian energy unavailable because of potentially secondary sanctions from the United States that would force countries like India to cut their imports? Do you see Germany essentially saying, we have to restrict Russian energy imports? Right now, continental Europe is really reluctant to turn off the Russian taps. But again, if Putin escalates, if he were to use chemical weapons, I think we're going to have to see further economic sanctions and efforts to defund Putin's war machine by cutting off his energy prices.
Okay, so we've now walked through the various permutations of what could happen. Walk through the various permutations of what you think happens, therefore, to the price of WTI.
I mean, look, I think we have to prepare for higher prices. The question is, will we retest the highs that we've seen in the past couple of weeks? I think that will depend on how Putin wages the war. One thing we're not likely to see is additional volumes coming out of OPEC. They're having a meeting tomorrow. There are no indications that OPEC is willing to go beyond the 400,000 monthly increase they've already agreed to. And we also have a question about how much more oil is really out there from OPEC producers. The estimates are that potentially they have 2 to 2.5 million barrels that they could easily bring onto the market. If Russia is down by 2 million already, and that is going to climb, there's a question about where the available barrel is going to come to fill this hole.
Lima, we're going to leave it there. Thank you for your perspective and analysis on all of it. Appreciate it.
Coming up by this morning's corporate headlines, and then later Tesla seeking a stock split for the second time in 2 years. Could that move trigger another rally in the stock? Already in rally mode, looks like. Before we head to break, let's get a check on the markets. Let's see, we're down but not out. Squawk Box will be right back.
Welcome back to Squawk Box this morning. We are live from the NASDAQ market site in Times Square. Here's what's making headlines right now. ADP going to be releasing its latest report on private sector employment this morning. Economists think the report will show about 450,000 new private sector jobs for the month. That compares to 475,000 jobs back in February. These numbers coming in ahead of the government's March jobs report, which is out on Friday, Jobs Friday. And the House has passed a bipartisan bill designed to boost retirement savings. The bill raising 401k and IRA contribution limits for older workers, as well as raising the age from mandatory withdrawals. Now, the proposal going to the Senate. Meantime, Pershing Square's Bill Ackman vowing a, quote, quieter approach in future interactions with corporate management. He told investors he plans to work primarily behind the scenes now with management at companies where he's seeking change. And he says he's permanently retired, from what he called, quote, activist short selling, such as his big battle, if you remember, over Herbalife in 2013. We got a lot more coming up on Squawk this morning. A closer look at the mortgage market amid higher interest rates. We'll talk that and so much more. A couple big debates coming up as well. And we come right back on Squawk.
Time now for today's Aflac trivia question. What popular candy turns 100 this year? The answer when CNBC Squawk Box continues. Now the answer to today's Aflac trivia question. What popular candy turns 100 this year? The answer? The Haribo Gummy Bear. The candy was first invented in Bonn, Germany in 1922.
Okay. They're not good to eat a lot of those.
No.
Mortgage rates surging over the past several weeks, and Diana Olick joins us now with the latest report on mortgage applications. I can't wait for the summer and the spring when you're outside in Haddonfield again. You're not there quite there yet, but we're looking forward to it, Diana.
Yeah, but all the cold, it destroyed the cherry blossom, so, you know, whatever. Look, Let's talk refinancing. It's taking a wallop from rising mortgage rates. Refi demand fell 15% in 1 week and was down 60% from a year ago, according to the Mortgage Bankers Association. Now, that is not good news for all lenders, but especially the non-bank lenders who were deep in the refinance business. You see names like Rocket, Loan Depot, and UWM all in the red year to date. It's all because the average rate on the 30-year fix jumped to 4.8% last week from 4.5% the week before, and it's already slightly higher this week. Mortgage applications to buy a home increased 1% for the week, but were 10% lower than the same week 1 year ago. Home buyers today continue to face sky-high prices and record low supply. In addition to rising mortgage rates, affordability is weakening dramatically, but some real estate agents say the competition is not letting up. It seems like whoever is out there is fighting to get what's available, but cash now is king. Some agents telling me they've never seen so much cash in a spring housing market. Back to you guys.
It's hard to believe with where we were, Diana, that the refi boom was still continuing. I guess you could do it. It seems like you need more than a point drop to do it, but people were trying to scalp as little as they could. But can't this be like the Fed, where we build it back up to where we got some room to cut, and then we'll be in another boom? They were too low to continue having these booms, these refi booms.
Well, look, the refi booms were based on the fact that we sat at record low mortgage rates for a year, basically. I remember saying that there were 13 record lows set, I believe, in 2020. And so when you had that, you had all of these people, millions of people refinancing, and the refinanceable population now is so low. We went from about 10 million who could benefit from a refi to like 2 million. So that's what it is. If you don't benefit, you don't do it.
Yeah, you better pick a different business. So people that have houses that they're selling now, do they price them low and then let the bidding begin? How much is that done?
No, I mean that's the issue with sellers right now. No, they know it's such a tight market. They know that there is so much competition out there. They're still pricing high, and they're still getting multiple offers with 50, 100, even 200,000 over asking. Crazy market out there.
That's amazing. Okay. All right. Thank you, Diana Olick.
A lot more to come this morning. Tesla shares, they are up big, and big time, I should say, this week after news of that potential stock split. So what could that mean for investors going forward? Plus, President Biden's proposed billionaire tax causing a stir on both sides of the aisle. We're going to talk to Skybridge Capital's Anthony Scaramucci and Congressman Ro Khanna for their takes on all of it. Stay tuned. You're watching Squawk on CNBC.
I'm happy to celebrate success. But let's remember, Elon Musk didn't make it on his own. He got huge investments from the government, from taxpayers, from those public school teachers and those minimum wage workers who've been paying their taxes all along to get that business up and running and help see it through rough times.
And that was Massachusetts Senator Elizabeth Warren on Squawk Box yesterday. It was a big debate in Washington and a key topic for investors. Does Tesla enjoy too many government subsidies? Joining us now is Gene Munster, Loop founder and managing partner, and Gordon Johnson, GLJ Research CEO and founder. Guys, Gene did, you should have seen Twitter explode when I tweeted that out. And a lot of people said that the loans were paid back in full. And the idea that, yeah, you need, it's kind of funny when someone says, yeah, well, you wouldn't be a successful company if you didn't have all those customers. Most companies do succeed because people use their services. I don't know if that's a real cogent point to make on why it wasn't really Elon Musk, it was his customers that put him on the map. It was pretty good. You didn't have a lot to work with in terms of that, her side of the argument. But did Elon Musk, Tesla paid back most of it? I don't think did GM pay back everything at this point?
Don't know. Maybe she's getting to some of those EV tax credits. And,
yeah, maybe she's talking about that. Yeah.
That's Tesla had a benefit from that. There's no question about that. Those have been moderated now, and I would say that a lot of companies get benefits for tax treatment around where policy is moving, where they want to move demand, obviously, around renewables. And so I don't feel like there was an outsized opportunity. It is true that Tesla has, because they sell more electric cars, they have more of these EV tax credits, and they will continue to do that. That's more, in my opinion, about really a surprising lack of innovation with traditional auto and their ability to really get those customers that you're talking about. And so when I put it together, I can see why a policymaker would bring this up, but I think it largely misses the point. The point is that consumers want their products. Even with tax credits, if they have subpar products, consumers won't buy them, and the opposite has happened. Tesla has grown deliveries on average at 4 times the growth rate of the traditional auto over the last 8 quarters, and I think that speaks to something that's going on beyond a tax benefit.
Gordon, even though you question the valuation on the stock and you question a lot of things about Tesla, but you're glad he did it in this country, right? And you appreciate the $11 billion he paid into the federal government on taxes. I mean, that's a good thing for everybody, isn't it?
Well, he then contributed over $5 billion to a charity, which some allege is his own charity, to circumvent taxes. So you got to look at all these things. But I think what's important here is over the weekend, we got 3 very negative data points. Data point number 1 was Andrew Karpathy, their head of FSD and AI, took a, quote, 4-month sabbatical. It's very interesting he's taking a 4-month sabbatical now when Elon Musk is saying they're going to have level 5 FSD by the end of this year. They're only at level 2 now. And what's important is the last major exec that, quote unquote, took a sabbatical or took a leave of absence, Doug Field, their head of engineering, who Tesla said wasn't leaving the company. 6 weeks later, he left the company. There's other executives, Jerome Gillen, Gabby Toledo, J.B. Straubel. All of these guys were said to take leaves of absences. They weren't leaving, and then they left. So it looks like Karpathy's out the door right when they need him most. Second data point, their Shanghai factory announced a 4-day shutdown. Shanghai was over 50% of their production last year and over 100% of their profit. And then the third thing that happened is key projectors of their deliveries in Q1 are projecting that their deliveries are going to significantly miss consensus estimates. The first 2 of those things, one could argue, should have gotten an 8K. But instead, we get an 8K over the weekend of Tesla's intention 6 months down the line at their annual meeting to get a vote for a stock split, and the stock goes up. Look, I think there's been a meme stock rally, a junk stock rally. You've seen AMC go up 170%, GME go up 130%, and I think that it's basically you're looking at unsophisticated retail investors, and you're doing things like announcing stock splits or buying gold mines that have been bankrupted twice and don't have really gold to mine to really push stocks up, and it's really sad what's going on. So I think when looking at Tesla's fundamentals, That's what we should focus on. With respect to the tax credits, I'll just say this. Every single year outside of last year, excluding credit sales, Tesla lost money. I think that's what Warren was getting to. Without the tax credit benefit, Tesla lost money every single year. So I think that's something to consider.
So, Gene, do you consider, I would never, just me, I don't consider Tesla like a meme stock like AMC or GME. Do you really think that there's enough similarities between Tesla and those two to all throw them in the same basket?
I mean, the circles overlap on the edges, and I would describe it as there is a kind of a religious aspect to the Tesla conversation. People
Based
feel
on something, no. It's, I mean, the other ones, I don't need anyone sending me anything, but it seems like there's a little more to go on. I see a lot of Teslas on the road.
It's not I wouldn't put it in the meme stock. I see Gordon's point just about kind of the emotion around it. And I would just say this: the goal here is not to prescribe to one religion or the other, the believers or the non-believers. It's to identify what's going on with the fundamentals. And Gordon points out that there could be some talent attrition, some important talent that probably he's saying he's going to stay. He's not going to be around in 5 years. I feel good about that. But I think what's most important related to meme stocks and what the difference here is to the fundamentals. And I would come back to our job is to identify how many vehicles are they going to sell over the next 2 to 5 years. What's the profitability around those vehicles? I mean, it's as simple as that. And I would say on the identifying vehicle perspective, if we're going to take the approach of trying to cut through the noise, Gordon's great at sharing with me different insights he have. I have an insight for people to look at, and this is inspired by Rob Maurer, who is pretty active, I would say, in identifying every detail around Tesla. But Rob pointed out the GM has a new factory in Spring Hill, Michigan. It is their new electric Lyric is the new car. It's just opening up. They also have the Giga Berlin factory. Both of those have videos that have been released. One of them was produced by GM. The other was not produced by Tesla. But I would just look at those videos. And the reason why I mention that, I think it draws a stark distinction. Now, GM is not the whole auto industry, but how traditional auto is approaching manufacturing versus how Tesla is. It is well spent 7 minutes of viewing. And I think that really anchors or is evidence to me about this gap that we have in terms of production and ultimately what I think is going to drive the stock, which is how many vehicles they're going to produce and sell. And one last point, and I'll turn it back to Gordon, is that they can't keep up with the demand. Shanghai being shut down, that's going to have a potentially negative impact on what the numbers are. That's very true in the near term. But I think when you see delivery times for Model 3 being this summer, Model Y, the earliest in the U.S. is October of 22 to January of 23. They give a range. They have reportedly 1.5 million pre-orders for Cybertruck. The Ford Electric 150 has somewhere around 250,000. Something bigger is going on, and we're just at the beginning of it.
Gordon, if you were actually short the stock, I was thinking it looked like you were doing okay there earlier this month, and you could have covered at 750, just or around there. I'm just wondering, as a guy that comes on and talks about Tesla, wouldn't that have been a good time to throw in the towel and say, all right, it's cheap enough now where I'm going long, and I'm a believer now? Or do you think we're going back? Do you think we'll go back down all the way to where it was, where you saw on that chart, and then back below that? And you think it'll be below 500 pre-split again?
Yeah, I think Tesla's going significantly lower. And listen, Joe, you get bear market rallies. Look, we're at an S&P level right now above where we were at pre-war, yet the war hasn't ended. And you have earnings coming out that I think are going to be bad. But to Gene's point, listen, we could talk about videos made unofficially by fanboys of Tesla and comparing that to videos made by GM. But let's look at the numbers, Gene. Let's look at the 10K where Tesla said their U.S. operations lost money. Their Shanghai operations were over 100% of their profit. Look at the Shanghai operation specifically. All of the costs are back and loaded. So I think Tesla is one of the least efficient manufacturers of cars. And what's important, Gene, is how many cars they're going to produce. To get to a valuation that justifies a company valued at more than the entire auto industry combined, they need to be adding roughly 100,000 cars a quarter of incremental sales. And I believe their sales this quarter could actually be down. So I think you got to look at the reality, Gene, and not just look at these kind of anecdotal details from Tesla, Twitter writers. And one last thing I'll note, again, I think it's very important to keep in mind their market share is falling. And again, when these Q1 numbers come out, what's going to happen? And the fact that they 8K'd an event that's 6 months out, I think that speaks volumes to what they're looking at. It looks like they're more focused on the stock versus the product. So Joe, I think that, as the market, this bear market rally fizzles out, which we think is happening, I think that the numbers that are coming out of Tesla are going to disappoint. And I think the stock has significant downside here. And to the meme perspective, I think it is a meme stock because you have them doing things like putting out 8Ks on events that haven't even happened versus real events like their Shanghai factory being shut down. So I think we got to focus on the fundamentals. And when you do that, it doesn't look good.
Dean?
Come back to our goal here is to identify how many vehicles. Let's separate from the market share piece. Their market share is going down, but how many vehicles? I think that they could do $400 billion in revenue in 2027. You put an Apple multiple on, it's a $2,500 stock. I'm not saying that the stock is going to go to $2,500 over the next 6 months. It's going to be up and down. And ultimately, I think that is what I come back to. I would just offer one other piece, and this is a religious piece. And I do fall. My job is to cut through the noise and identify number of units and profitability. But there is one a piece that I am guilty of having religion on, and that is a belief that using traditional auto as a benchmark to how to value Tesla is misleading. Not misleading in the sense of trying to steer people in the wrong direction. I think it's just the wrong lens. And this is just computer on wheels, and it's about revenue, it's about profitability, it's about a massive, massive TAM. The real thing that should keep investors up at night, Tesla investors up at night, is not about GM and other automotive. It's about what eventually Apple, if in fact they get into the business. I'm not saying that they are going to get there, but those are the companies. It's going to be the tech companies that are going to really redefine this, and I think that changes the whole dynamic around valuation.
Okay, Gene Munzer, Gordon, thanks for both sides of this argument. I don't know if it's ever settled. We'll keep having you back. Thanks.
Coming up, the president's budget proposal could have companies thinking twice about remaining a public company. Robert Frank's going to have the details next. And then wild swings in GameStop and AMC this week. We're going to break down the moves and find out if the retail investor is behind them. A reminder, you can always watch us live on the go. You can do it right now on the CNBC app. We're right back after this.
President Biden's proposal to tax billionaires could have more companies and their founders thinking about going private. Robert Frank joins us with another angle to the president's tax plans. Hey, Robert.
Good morning, Joe. Well, there are two categories of taxpayers in the billionaire tax. You've got the liquid wealthy, or those whose wealth is mainly held in tradable assets, so like stock. The illiquid wealthy, those with at least 80% of their wealth in a non-tradable asset like a private business or property. Now, the liquid wealthy, they would have to pay an annual tax of up to 20% on unrealized gains. The value of their stock is marked to market at the end of each year. So even if they don't sell a stock, they still have to pay the tax every year. But owners of private companies can defer the tax until the business is sold. So that's a huge difference. The White House saying this is all aimed at helping family companies manage the tax without being forced to sell. And there is an interest charge that private owners have to pay when they do eventually sell for deferring that tax. But tax advisors say that over time, this amounts to a substantial tax break for private company owners and could lead more companies to go private, or at least fewer private companies to go public. It could also incentivize big stock investors to move more money into real estate, art, and other less liquid and less easily valued assets. Joe, that's not to mention the problems you're going to have with disputes between private company owners and the IRS about valuations. We already see that a lot with the estate tax, and only about 2,000 people pay the estate tax every year. You're talking here about probably more than 20,000 people a year, whether it's tradable or untradable illiquid assets, that would be subject to this tax.
Is there enough wiggle room, Robert, in the way this is being done to get around the we only tax income, we don't tax things that aren't realized? If it's sort of they're almost calling it a deferral on an eventual event, on a sale or a death. I saw one of, All the President's Men. Was that a movie or a book or something? So I saw Jerry Bernstein on yesterday, and he said, we've looked at it and it will pass muster with the courts. Is that, do you buy that?
Well, it's really going to come down to whether you can treat an unrealized gain as income. And the Constitution is clear that you
need to tell me.
I mean that's what the court is going to have to decide. I mean, the White House is calling this income. We have always called it wealth. When you have a paper gain that you cannot spend, you can't do anything with it until you sell.
It's a prepayment.
Is that really income?
It's a prepayment of when you're going to sell it. So, well, is that enough wiggle room for? I guess it depends on the court. Or who's deciding?
No, and you're right, and that was clever, is to say, look, this is going to be a credit toward your eventual tax,
right?
And then of course, and then of course, if your stock goes down one year, that credit is lowered by that amount. So it's also a way, by spreading those payments out, it sort of smooths the payment stream for those big up and down volatile years, especially with the big tech founders.
I don't know. I'm so conflicted about this because I hate the idea of taxing unrealized gains. I hate it. But at the same time, I also think we have to capture more revenue. There's the principle of it.
You said earlier today, you said you were content. Robert, earlier, Andrew said he was content with how much revenue is coming in. We just need to spend it more effectively and move it around.
Oh, well, that's true, too. But
well, make up your mind. You want
well, we're getting huge revenue right now. I mean, we're getting record revenue right now at the state and federal level.
Now, is that what you were trying to catch me on? You were trying to catch me on.
Keep it where it is.
Oh, you just want to keep the. Okay, but can we read the mix? Can we shift the mix?
Definitely.
Shift the mix of where the revenue is coming from.
Definitely. We can take everything away from military spending now. We don't need that. There's never going to be another.
I'm not making that argument.
No, I know, but others have. Now, so non-discretionary, Robert. We got a means test.
Robert, you got to come in here, and we just have to do like an hour on all this together. I think that's got to be the move.
Would love it. Tax day. Tax Tuesday.
Day.
Next week.
Right. It's coming up. Oh, my God. I just did the last ones. Coming up, meme stocks swinging wildly. Do you ever not get an extension? I mean, I have to. In yesterday's session, well, I have out. If the retail investor back, we're going to see whether that's true. Whether he's back and here to stay, he or she. As we head to break, check out the shares of Lululemon, reporting earnings that beat estimates by 9 cents, although revenue fell short. Lulu also announced a $1 billion stock buyback program. And looking for the best investment ideas and themes in healthcare now, CNBC's Healthy Returns is happening today, featuring the CEOs of Walgreens, Johnson & Johnson, plus actionable insights from top investors and much more. You still have time to register.
Returns to be healthy.
I know, yeah.
Yeah.
It's a good name that we came up with. Go to CNBCevents.com. Squawk Box, be right back.
Meme stocks are making a comeback this week. Stocks like GameStop, AMC, they're all up to their highest they've been now in months. But is this growth really sustainable? Joining us right now is Tom Sosnoff. He is Tasty Trade's founder and co-CEO. Tom, what is going on here? Can you explain this?
I wish I could. I don't know, except it's a good thing, Andrew, when we get a little bit of action in meme stocks. It brings everybody back into the market. It's good for engagement.
But what do you ascribe this move to?
I think it's a combination of a lot of risk off in the commodity markets and a lot of excitement about, just the recent rally we've had. It had a huge rally over the last 2 weeks. And there's been, a huge decline in implied volatility. There's been, they've crushed a lot of the a lot of money went into things like, wheat, corn, soybeans, crude oil, a lot of selling in the bond market. And I think it's just think of it more like a sector rotation into things that people like to trade. They like to there's a lot of noise, and traders love noise. And okay, so
tell me about the AMC apes. We're looking at a screen now. That stock's now $29.84. Yeah. I don't even know if there's going to be a movie theater company when it's over. They're going to be in like all sorts of other investment. I don't even know what it's going to be. It's going to be like a conglomerate. I don't know what it is.
I mean, you and everybody else. I mean, I look at the stock at 29. I mean, I think it traded 200 million shares yesterday. I look at the stock at $29. I mean, I think of it just in terms of, I'm an opportunist. So I think of it in terms of, okay, it trades a lot. The option markets are tight. There's huge volume. There's a lot of efficiency in there. And the expected move over the course of the next 15 days is $10 on a $30 stock. That's where the excitement is. I don't.
So this isn't like just DraftKings. We should just. But so.
Yeah.
That's what it is.
The answer is yeah. Yeah, that is the answer. The answer is you can't think of AMC fundamentally. You can't think of, hey, what are these guys going to do? Because they probably have no idea what they're going to do. I think you have to think of it as, hey, it's a tradable stock. It's in play. And it's just, it's a certain level of engagement. Meme stock mania, for whatever it is, whatever that means, it's just good for business. It's good for your business. It's good for our business on the trading side.
Though, what about? I mean, look, there are going to be some winners, but there's going to be a lot of losers.
Yeah, but it's efficient. So
you can losing. I don't understand.
You can complain. You can complain about inefficient markets because then it's not fair. But when you have efficient markets and you can buy or sell each side a penny wide, you can't complain. Either, you can take either side. So you can't argue about a penny wide market that trades 200 million shares.
I don't know, Joe. Joe and I love Bed Bath. Bed Bath is a meme stock now.
Right. No, I was trying to think of an analogy, and I couldn't come up with any that are okay for air.
But I think,
basically, you're like saying, I mean, think of some terrible thing. It's like, wow, it's great for the emergency room business. Yeah, a lot of people are in here. It's not necessarily great, Tom. If it's long term, if it's just all speculation based on nothing, it brings that gambling aspect into the stock market. I guess we still want to think we're Graham and Dodd, and we're not, because nothing is anymore. So I guess we might as well.
So all of this
I
is
understand what you're
fakery?
saying.
I mean, I don't know.
Yeah, no, I think the argument is, if you're in an inefficient market, meaning that it's unfair on the retail side, then I completely understand. But if you have a two-sided market that's a penny wide,
people know what
who cares?
Doing.
I mean, if it brings people in and it gets excitement and it gets you engaged.
Doesn't it just say, if that's pretend, if you think that the meme stock phenomenon is some kind of pretend land where fundamentals don't matter, you have to almost take it to the extreme. I don't know if it's the extreme, but then you have to say that the whole thing is pretend. And here we are. Is it all pretend?
Well, I don't think the whole thing is pretend, but I think that, you can question fundamentals. If you believe in efficient market theory, you can question fundamentals all the time for virtually anything. I mean, you have to kind of believe that everything that's known is pretty much in the marketplace. So what you're really hoping for is the opportunity to trade something that has tight markets and it's sufficient. That's what people get. The whole business is about noise. And wherever there's noise, that's where everybody gravitates to, because that's what's exciting.
What does this say, though, to the extent the meme stocks say anything about what we're seeing, for example, in some of the FANG stocks, which have started to come back despite the fact that interest rates are going up?
Yeah, I mean, what it says is that there was a lot of interest in stocks. There's a lot of money on the sidelines, and people were scared, and rightfully so, for a couple of weeks. And what it said is, when you saw volatility start to come down, it came down from in the mid 30s all the way down to the low 20s. That's a lot of risk off. And when you saw these commodity prices start to drop so much, you realize, okay, it's been a risk off couple of weeks and people are excited. And when there's that much excitement, listen, you can't get as much as you want to look at the Apple move from 150 to 175 and say, hey, that's great. People tend to get more excited about a crazy stock like AMC. I don't know why, because I don't, but a lot of people get more excited about a stock like AMC going from $15 to $30. And, listen, I understand it. It's a cheap stock. It's a cheap stock with tight markets. It's easy to trade.
If you think the meme stock phenomenon makes no sense, where's crypto in your life?
Well, crypto's a little bit different, because to me, the future of DeFi is a very important part of what we're going to be looking at for the next decade. And crypto, throughout this whole move over the last month or so, really validated itself as a pretty stable asset class. It didn't budge much. So I think if you look at crypto and you think about the future of decentralized finance, and you think about globalization and what we're going to be talking about over the next couple of years, which is probably globalization through secure tokens and the way we're going to be able to trade things 24 hours a day, 7 days a week.
And we've got Bitcoin, Ether, Litecoin, Ripple, and Doge on the screen. What do you want to own?
Of those, I want to own Bitcoin and Ether.
Okay. Tom, it's a longer conversation.
I would love to have this conversation because I love it.
We're sort of having these very philosophical conversations about what this is all about.
Still haven't come up with something that for air.
Tom, we'll talk to you soon. Appreciate it.
All the crime in New York must be good for something. What's going on now, right? Good for the court system? I don't know. It's bad for the court.
It's a mess.
It is a mess.
I would think, but the audience isn't going to be happy with that either.
No.
Meantime, it is just after 8 o'clock in New York. And yes, you're watching Squawk Box. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Joe Kern. Becky's off this morning. Futures right now.
Index, though, was up. Now, later here at GDP data, and, well, take a look in terms of what's expected here as far as quarter over quarter, looking for an increase of 7.1. Prior was 2.3. We'll take a look at the GDP price index, and that's expected to come in at 7.2%, flat, in line with last reading. And then real consumption spending, looking at, again, prior reading of 3.1. So we'll be keeping an eye on those numbers, in addition to, again, the jobs numbers this morning. The ADP comes out in, well, just about 12 minutes. We'll take a look at that. We've got some charts, some levels to keep an eye on. And, well, now that we've had a look at some of the top stories that are moving markets, some key levels here in or where things stand as we get set for the cash open, I should say. Let's take a look at some key levels in the indices. I want to take a look first and foremost at the run-up we've seen this week since the open Sunday. The ES really adding to the gains that we've seen over the last couple weeks now that we've been on the move off those March lows. We bottomed out down around, I think it was 41.29 or 41.2850. I don't remember exactly. We'll look in just a minute, but I wanted to point out here, it's not just the move off the March lows. Again, the last couple days really holding these upper levels, no rejection of. And in fact, we took out the February highs this week, so up and through 4,600. But let's just kind of zoom in on this dark shaded area here. This is the day session trade from yesterday, the move up to 46.31. And let's take a look at the ES here. And again, the talking about the day session trade from yesterday and then the overnight, how, you know, no rejection of these upper levels. We've been kind of in a bit of a grinder for the most part in these overnight sessions, but with the day session advances and holding throughout the overnight session, again, we've been able to, well, mount a bit of a comeback off those March lows. As I mentioned, the Dow up to 35,281 yesterday, and, well, again, holding these upper levels for the most part above 35,000 as we speak. Take a look, similar pattern playing out in the NASDAQ. They got back up above 15,000 this week, and they're holding convincingly above that closely watched, again, nice round number, psychological level, I guess is the best way of putting it. Speaking of a psychological level, the Russell above 2,100 this week. So again, this is just the day session trade yesterday, the rally we saw, the sideways consolidation, and the acceptance of the recent price activity and the bid that we've seen. Now, as we take a step back and, as mentioned here, look at the run-up that we've seen this week, I do want to point out here, well, that it's not just this week, as I mentioned here. It's off the March lows where we bottomed out. What was that, to be exact? Let me just double check here. It was 41.20. Let's see, 41.24 was, well, in the 41.20 area again, and it did hold up above that Feb low, as mentioned, down around 4100. Now, this is the ES, the move off the all-time highs we saw back in January to that Feb low around 4100. So we have a pretty well lower extreme established here right now, and at this point here, we're trying to take out what was a pretty good upper extreme. Again, those February highs and in January levels to keep an eye on now. Pointing out the ES, a pretty good representation of all four of the majors here, as it's back above the 50-day moving average, as is the case with the NASDAQ, the Dow, the Russell. Here's a good look at the quad chart. All four of them collectively, you can see back above the 50-day moving average. Now, take a look at where things stand relative to the 200-day moving average. On the left, you have the ES. It was the first to get back up above the 200. You've got the Dow now above it. You got the NASDAQ right on it, basically, to just above it. But again, the lone sheep here, kind of the outlier, I guess is the best way of putting it. The Russell holding below the 200-day moving average. We've got the VIX after taking out the Feb highs this month all the way up to 3650. It's come off now, and, well, we're right back down to those Feb lows. So you can see quite the range over the last couple months in terms of volatility with the Ukraine this month, the activity that we've seen over the last, well, I guess it's now been 5 weeks, I guess for that matter. You can see, again, how it's factored into that series of higher highs and higher lows that we've seen. Remember, though, this volatility came into play based on rates on the rise and some concerns that could have on economic conditions here in the U.S. in terms of growth, and that was impacting the growth stocks, if you remember, specifically some of those tech names, the NASDAQ. Well, again, all of those fundamentals that started the sell-off in the beginning of January remain. So we'll continue to watch the indices, some of those key levels that I think you should be watching there throughout the day on a regular basis here. So stay with us for that. But, hey, I want to shift gears. I want to move away from the indices. I want to talk energies. We have David Williams joining us this morning. He's an investor. He's a forecaster at Page Trader. David, welcome. We were just talking about how it's been, well, a long time since the market's been so headline-driven, commodities, indices for that matter. I guess the question I have for you as a technician, does it make the technicals more reliable or less reliable when we're seeing this kind of intraday volatility tied to some of the fundamentals and, again, oftentimes just headline news?
Hey, good morning, Ben. Great to be here. You know, volatility is for us what makes the markets better for technical analysis. Markets tend to run to distant targets. The market has the power to get to numbers. It has the power to reverse powerfully. We prefer normal or high volatility to trade in, normal, medium, or high. We don't prefer having lesser volatility, smaller than normal volatility. So it is, I would say that I think many technicians would agree that higher volatility helps. It doesn't hurt. It helps the market to be able to do all the things that the technicals are pointing to.
Yeah, it kind of gets us to the levels that we look for or that we've identified, it seems like at times, those volatile swings or the fundamentals that contribute to. You know, we sold off yesterday on the constructive comments from in terms of relating to or describing some of those talks in Istanbul from Russian negotiators, which seemed to be good, probably one of the more positive comments we had heard in a while. We did hear the Ukrainians kind of dialing them back, basically saying, look, we're pushing for a 48-hour ceasefire to get some of the people out that want to leave at this point and can't, and we still don't have that. So, again, we were trying to provide both sides in terms of representing this story, but, you know, it really shows to the sell-off that we saw in terms of crude yesterday, the rally back today. I mean, on a bit of a roller coaster, as I mentioned earlier in the show, and again, tied to the news and these headlines.
Yeah, no doubt. A continuing combination, Ben, of COVID-based lockdowns in China, which can dramatically slow the consumption of transportation fuels and thereby take some heat off the market, along with the slightly positive, as you just mentioned, Russia-Ukraine negotiations, which maybe today are not so positive, are helping to keep the crude oil at somewhat more reasonable prices and certainly off the recent highs of $130 per barrel. Last time when we were on your program, I forecast that we would not be seeing the $130 crude oil price again anytime soon, and that the crude oil market would tend to trade at around 105 to 103, particularly into the third quarter of this year. And as a matter of fact, we are already seeing crude trade at around the 103 to 105, even in this time frame. And we have early indications, Ben, for the second quarter of this year, crude may need to trade even lower at both $94 and at $89 to $87 before reasserting the longer-term uptrend to again trade at 103 to 105 or higher in the third quarter of 2022. So crude oil is not out of the $100 per barrel crude oil business during 2022. We're going to see plenty of it. The market has to be considered to be very volatile and very high priced for much of the remainder of this year in terms of our forecast.
Okay, sounds like the contribution that crude's had to some of those inflation concerns will remain. Then I guess the next question is, with the ongoing negotiations, we're nowhere near the end of the ride yet in terms of this roller coaster ride, it sounds like, as far as some of that intraday volatility. I mean, we're going to continue to get headline news, comments, positive or negative, as talks continue.
Yeah, and you know, Ben, as you know so well, investors are smart. They have already priced in very, very many of the possible outcomes. People think these things through. A lot of what could happen has been priced in, and I give the fact that when something really becomes a fact, it can make a spike in the market. But a lot of things have been priced into the market. A lot of outcomes have been priced into the market so far. So there really will probably have to be some larger surprise to really get crude oil to be back above the $130 mark. And as I said, even in the second quarter of this year, which just begins in a couple of days now, in the second quarter, we're probably going to see 94 and 87. A quarter is a decent period of time, so it's not necessarily going to be right off the first day. But, you know, we're probably going to see some pullback, but we're going to be in the $100 crude oil business for quite some time, continuing into the third quarter of this year.
Yeah, $20 from where we're trading right now does not seem far-fetched, considering some of the intraday volatility. Real quick, stay on this chart here, because I want to point out we do have our lines drawn in terms of the upper and the lower extreme. But again, with you talking about potentially to see, again, we're talking 84 to 94 potentially. We'll keep an eye on those levels. But again, it doesn't seem that far out of reach at this point. I do want to take note of how the most recent pullbacks did just get right back to the 50-day moving average. So that's something to watch here, right around 97, 98. Larry, talk to us in terms of, well, again, any other products that you have your eye on, any other levels that you're watching? Sometimes you have some levels in the indices for us to keep an eye on as well.
Yeah, no, sure, Ben. Across the internet, right now, there are those analysts who believe that the S&P is kind of in a crash position, looking to take out the lows of 4,100 that we made in February of this year. However, in our work, February is a very important bottom. We're not amongst the group that believes that that low is going to be taken out anytime soon. And as a matter of fact, we believe that the S&P will continue to advance with the usual declines that come along with it, up to $4,720 to $4,740 or higher, again, into the third quarter of this year. So the 47.20 to 47.40 target that we have could be reached as early as the second quarter, but it's a small possibility. But the on-time period for that completion is in the third quarter of this year. And then, Ben, secondarily, and maybe more importantly, then a failure in the third quarter of this year at that 47.20 to 47.40 level or slightly higher in the third quarter would bring a larger decline, which will, in our forecast, take out the $4,000 level in the S&P and do that into the first or second half of 2023. The second half of 2023 as a 6-month price bar, that's when we're expecting that bigger decline. So, you know, this we see, you know, right now we see continued monthly closes above $4,200 in the S&P would keep this forecast intact. Finally, if I can just throw this in for the S&P, I know I'm throwing a lot at you here.
No, keep going. We're on you.
Shorter term, we believe that we'll see another test of 44.70 or 60 or lower again in the second half or the second quarter, sorry, of this year, which begins in a couple of days. So the bigger picture, if the people want to think of it this way, we go up into the third quarter to 47.20 to 47.40 or slightly higher. Then we come down and we take out the 4,000 lows into the first or second half of 2023. That's the bigger, broader picture that we have for the S&P. I hope that helps.
You know, I just wanted to get your thoughts in terms of the fundamentals in the S&Ps potentially to the upside here. It seems like worst case scenario, Russia-Ukraine scenario, and then again, the ripple effect on global economies was sort of factored in into the end of March, end of February, I should say, beginning of March, when the S&Ps were down around 4,100, 4,200. Now up at 4,600, it seems like some of those concerns have been shelved a little bit, but yet at this point, I guess I'm wondering if we were to get some really good news, if we were to get a ceasefire, for example, if we could see some release to the upside on the positive kind of overextend things to the upside sort of nature of price activity. You mentioned how investors are pretty smart and oftentimes they can price things in, or they do price things in. I mean, it seems like some of those worst case scenarios got priced out where we are right now, but not necessarily a best case scenario priced in, I guess, is the thought.
Yeah, no, that's well said. I think that's a great point. Investors are smart in the sense that they can price in future potential outcomes. And those they seep into the market, whether they know it or not. It could even be unconsciously that people feel more comfortable or less comfortable. They price outcomes in. But with regard to war and the outcome of S&P, historically, war in one form or another has been bullish for markets. And, you know, a lot of us, and I would be right in that same camp, would think, well, we may have a relief rally if something good happens here. That's quite possible. But I do want to say that historically, war has been bullish on the market. And while that's unfortunate, it's just the nature of markets, particularly the indices, to be bullish during war periods. And it essentially is a war, but it's a negotiable war right now. And so, you know, I can't really be sure if we turn or not. I do know this, that we're close to a top in the S&P here, at least in the short term. And longer term, I gave out the forecast for the move up into the third quarter and then down into next year. So we love that. And finally, Ben, if I can, one other thing, and we're not specialists in natural gas, but I know you sometimes ask about it, and I do want to put something out for you. We think very short term that natural gas, the current market, will probably continue down to the 533, 532 or lower into the week of April 11th. So that's something for you to watch. It's not our specialty market, but I wanted to give something for people to watch for in the natural gas market as well.
All right, I like it because we recently just came off a bit of a double top around this 560, 550 area, depending on how you want to look at it. We are starting to see some lower highs come into play. It'll be interesting if we do retreat a bit here now. So we'll keep an eye on the natural gas, the ES, the levels you brought to our attention, and crude as well. David, always a pleasure to have you on the show. Thanks for sharing your Wednesday morning with us. David Williams, investor and forecaster at Page Trader. Stick around when we come back. Michael Zrensky joins us from Charles Schwab to get ahead of the GDP number headed our way today. And, well, lots more of the information you crave about the futures markets you trade when we come back.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Future Show here on the TD Ameritrade Network. Before the break, we were talking top stories in moving markets and key levels in the indices, well, energies as well, for that matter, for you to keep an eye on. Let's bring in Michael Zrensky. He's the Director of Futures at Charles Schwab. He's joining us this morning to get ahead of some of the eco data. Michael, I actually would like to begin with the ADP number. Right into break, we actually had our first, well, I guess the jolts yesterday was one of our first employment numbers here for the week, a week very heavily focused on the jobs reports. ADP non-farm employment just came in a little bit better than expected. Not sure if you got a look, 455,000. They were looking for 450,000. It looks like prior got revised up to 486,000, so a pretty strong number across the board, feeding into what we've heard from Fed Chair Jerome Powell in terms of really strong labor conditions here in the U.S.
Good morning, Ben, and that's absolutely correct here. I think Chairman Powell there kind of summed it up well here, that the labor market is still strong, and today's ADP data, like you said there, Ben, are pretty much with expectations there. But if you look more into the details there, overall, it was I think even a lot better number than last month's as well, too, especially when you start to look at the breakdown of where those jobs were added there, because I think the key thing from last month's ADP number there was that the small employers showed a job decrease there as well, too. They really had trouble, bringing in workers there as well to compete with some of the, the larger companies with benefits and wages there. But that rebounded in March here, so that's a good sign as well, too, and it's really very evenly distributed as well, too. Service sector did well once again, but we also saw manufacturing show over 50,000 new jobs added as well, too. So overall, it's a very steady number there, right in line with expectations there. So I think that kind of bodes well there for Friday's non-farm payrolls report.
Sure does. The market this morning, though, it seems to be a bit more focused on some of the headline news that we have been keeping an eye on and reported at the top of the show in terms of Russia, Ukraine, the war on Ukraine, and negotiations, which again, depending on who you listen to, are a little bit more productive at times than not, but still at this point have yet to really produce anything definitive.
Correct, yeah, as well, too. And the market is really reacting to those headlines there as well, too. So you've seen maybe a little bit more pessimism today out of some of the Russian officials there with the negotiations here. But let's face it here, the market has had a great, 2 weeks, 3 weeks here as well, too, up well over 10% in the S&Ps from the recent lows here as well, too. So it's not surprising maybe we see a little bit of a pause here as well from the steep run up. Plus, we're getting into the end of the quarter here as well, too. I think some of the recent strength here may have been a little bit of window dressing here by some of the large funds here trying to capture the, some of the positions here in this rally here. So it wouldn't surprise me we see the markets maybe pull back here a little bit as we go into the start of the second quarter.
Okay, Michael, I want to get your thoughts on this GDP number headed our way, but first, the yield curve inverting briefly, very briefly. Does it ultimately trigger that recession watch once it goes into negative territory? Does it have to stay in negative territory for a little while? And ultimately, how much attention are you giving this?
Well, I think you got to keep an eye on it for sure there, especially if it becomes entrenched here. But right now, we're really just seeing the curve really just kind of flatten here as well, too. And I think unless we really see the curve invert for quite a period of time, maybe 30, 60, 90 days, and even then, the outlook for a recession there probably is going to be out between 9 months and almost 18 months in the future as well, too. So right now, I think it's just something to keep an eye on here as well, too, but I don't think it's really sending any major alarm signals yet, though. But definitely keep an eye on, especially if you start to see the really short end of the curve start to gain on the longer end, and start to see the 3 month to 3 month 10 years start to really tighten. That's when I would get definitely my warning signals on there that, maybe we're in for a little bit of a rough road ahead.
All right, for that, we'll continue to watch economic data here in the U.S. and globally for that matter. Speaking to that point, I just wanted to bring up, I'm not sure if you got to look at the German Cpi, which just came out this morning as the show started here at the top of the hour, 2.5% on a month-over-month basis. They were looking for 1.6 year over year at 7.3. That's up from 5.1, so a spike. Interestingly enough, the euro's coming off a little bit, but let's talk about a little closer to home here. We're going to get some numbers this morning. GDP, it looks like on a quarter-over-quarter basis, we're looking for 7.1% consensus above the 2.3. GDP price index, we're looking for 7.2, in line with expectations. The PCE we'll get a look at, real consumer spending. How much attention is this number getting this morning?
Well, I don't think it's going to get much attention there unless we see something really that deviates from the expectations here. I think the markets, this is the final number here for fourth quarter there. We all know it was a strong quarter as well, too. We all know prices were elevated as well, too. So I want to look forward now. I want to, like I said, just like some of the other data there, I want to look at the more closely aligned data here. So let's start looking at first quarter estimates there. And I always look at that Atlanta Fed GDP now there. And they're looking for first quarter GDP to be 0.9%. So we're talking about a big drop down in growth expectations here from the fourth quarter there. And I've even heard some analysts starting to even look at second quarter revising downward as well, too. So we're not going to see that strong growth we've seen in 2021 here. We're going to definitely see a little bit of a slowdown here. Estimates now maybe between 2.5 and 3% here for the full year 2022 here. But I mean, overall, like the Fed said, those are still overall good growth numbers in the longer term perspective here as well, too. But it's definitely going to be slower than we've seen in 2021. So like I said here, since this is, a number here that's been kind of updated here the past several months here as well, too, unless we see a big change in the number here, I think this one's going to be kind of shaken off.
Okay, so the takeaway there being we're still well away from talking about negative GDP, and again, ultimately talking about a recession. We need to see, 2 quarters in a row, and again, even with that yield curve inverting, I mean, that's, as you mentioned, 18 to 22 months away or something like that is predicted, right?
Exactly right. Yeah, it doesn't just happen right away as well, too. And like I said, you need to see that curve really stay inverted for
entrenched, as you said, I think was the word used.
Exactly right. exactly entrenched here, and we're not seeing that right as well too. And even look at the rates here as well too. We had that kind of spike up as well across the whole curve here, but now we're starting to see a little bit of a pullback, and it looks like for the 10-year note, that 2.5% level there is finally a level there where we're seeing a little bit of a pressuring down as well too. So I'd be very interested to see if we could actually break through that level there, or maybe we've kind of maybe topped up there for a while here as well too. And especially we start to see some of those slower growth and see some of these numbers there start to, kind of be a little bit weak here than anticipated here. We may start to see, once again, these ranges here for the 10-year note going to another kind of range bound, maybe between 2.25% and 2.5%.
Michael, the JOLTS number yesterday is basically showing record job openings still as we hold around 11 million. We had a strong ADP number today. Again, GDP this morning. A couple other Fed speakers in between now and the end of the week, and some other data points to keep an eye on, but I'd imagine the focal point here is pretty squarely on some of the headline news out of the war in Ukraine and ultimately the jobs report as we wait for Friday's non-farm payrolls.
Absolutely right there, Ben. And I think there, especially if we look at what was going on with the jobless claims here the past several weeks as well too, and that's going to tie
tomorrow's
into
number.
Pretty good. Yeah, pretty good number there, I think, for Friday's data there, because we've seen those claims are really pretty steady there during that reporting period for the March data here. So I think we're going to see a decent number there, and I think the market is prepared for a decent number there as well too. You just don't want to see, I think, an overly strong number there. Could actually be a little bit of a negative, because that's going to give the Fed even more reason there to get even tighter there with their interest rates hikes here as well too. Though the market's got, I think, a 2 and 3 probability there of a 50-point hike there in May and possibly in June as well too. So like I said, the markets is kind of, I think, getting used to this as well too, that Fed's going to try to start to get ahead of the curve here. Now, kind of a takeaway for what I'm looking at overall here, it seems like the markets now, we had this kind of spike up moves, especially in commodities. We're seeing that pullback really across the board there as well too. Now we're starting to see these markets kind of ranging as well too. Volatility in the equity markets, and we've seen, look at that VIX really kind of move down there below 20 there on the spot VIX as well too, and that's obviously corresponding to this straight upward move here in the equity markets here. So I think that market here is also probably getting ready for a little bit of a pause as well too. So I think we might start to see, maybe a little bit of a quieter markets here the next several days or even weeks there as well too, unless we see some kind of real change here in this Russia-Ukraine situation here as well too. But I'm looking for maybe kind of a little bit of a break here from these kind of trending markets we've had here the past several weeks.
Okay, well, as you mentioned, maybe a top here in the TNX recently to 2.5%. Michael, appreciate you joining us. Michael Zaremski joining us from Charles Schwab. We're going to take a quick break, check in on GDP, financial markets reaction 2 with Larry Shover, the Chief Investment Officer at D. Alexander Capital. Stick around, lots more futures after this short break.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the second half of the Future Show here on the TD Ameritrade Network. We're now less than 60 minutes away from the cash open for stocks on Wall Street. Futures here in the U.S. suggesting a lower open this morning. Let's bring in Larry Shover, the Chief Investment Officer at D. Alexander Capital. Larry is joining us this morning to take a look at the market reaction to this GDP number. Larry, good Wednesday morning to you. It's good to have you with us. I'm noticing a little bit higher than expected in terms of the PCE prices, but I'm looking across the board at this number. GDP quarter over quarter below expectations of 7.1 at 6.9. The price index below expectations of 7.2 at 7.1, while again, that GDP is well above last reading of 2.3. It did miss slightly. Talk to us in terms of your initial reaction too.
Yeah, my initial reaction is that it's a placeholder to tomorrow and Friday. I mean, At this point, the numbers weren't too off, and the reaction, in my mind, based on how little they've been off, is probably going to be limited. I mean, we've had some significant moves overnight before the number, especially in the front end of the yield curve, but this number probably won't influence our market today.
Larry, I'm curious, we've been talking a lot about this yield curve inverting here right now, the 210. We were just mentioning how it was very short-lived for the most part, and Michael said that it needs to become a little bit more entrenched, he thinks. What is your take on this temporary cross over that zero threshold?
Well, what happened overnight was telling. We had a rejection of the first attempt to get the 210 inverted, which we did see mildly. But rather than seeing the curve steepen via duration sell-off, what happened overnight was really telling. I mean, there was solid buying in twos. Think about the two-year yield yesterday hit as high as 245, and overnight, last night, just about 229. We had a 16 basis point move on really no information, no fundamental data, and to me, that's kind of telling. That said, I mean, I'm still thinking we're going to invert. I'm looking at -6, what we saw in 2019, which fits very comfortably in having two rate hikes, 50 basis points in May and June, and 25 basis points throughout the rest of the year.
Larry, what does this mean for the U.S. dollar? It's been relatively elevated, and, I was keeping a close eye on some of the kind of tug of war and push and pull that we get from some of the other foreign currencies, because oftentimes the dollar isn't necessarily tied directly to rates. It's more kind of influenced by the euro or the yen. Recently, I saw the dollar again has been, holding above some key levels to the downside, while the euro's nearing those March highs, kind of rallying its way back. But the dollar seems sort of supported by some of the weakness we've seen in the yen recently. I'm sure you're aware of what's been playing out there as the BOJ tries to protect that 0.25% yield cap. A lot going on there in terms of currencies to sort of, again, influence the greenback.
Yeah, absolutely. And, my long-term trend for the dollar is still higher.
Okay.
Medium and short-term is also higher. And I know that there's so much good and so much perfection priced into the dollar versus other crosses. But until further notice, until some of that gets baked out of the price, I can't see a big retracement in the dollar, especially versus the euro. Perhaps the yen, but I think overall, I think the dollar is going to continue to march higher throughout the year.
Larry, when I look at the dollar, sometimes I think about it being kind of a reflection of investors' concerns, unease, uncertainty. Now, we looked at the VIX earlier in the show. It's come off significantly back down to the Fed lows. Dollar, again, remaining relatively elevated for that matter, and it holding in that range. But we also talk about it being a reflection of some of those geopolitical tensions. I guess, is it a reflection of some of the concerns in terms of the Fed's ability to navigate a soft landing at this point?
Yeah, I mean, absolutely, that's part of it. We've seen 9 recessions since 1960, and post tightening, and 4 of them haven't had recessions, like 65, 83, 1994, 2015, and all of them, we've seen the same thing with dollar and with rates. And what might help the Fed engineer a soft landing this time is that unemployment rates are at a 50-year low. Inflation is a multi-decade high, and real funds rate is still very, very negative. In all the other cases, when we've had recessions, inflation's been low, and the Fed's been trying to fight from it going higher as opposed to pulling it down. Unemployment rates were high, and Fed fund or real Fed fund rates were positive. So it is different this time. It's always different, as you know. But I do have hope, given what I just set out, that they can engineer a soft landing.
Larry, what have you seen recently in terms of some of the emerging market currencies?
Well, right now, in emerging market currencies, very interesting because a lot of them, as you know, tied to the dollar, but also some of them are tied to commodity prices and stuff. So there's a tug of war. And talk about this time it's different. I mean, this time it is different because a lot of times some of these emerging currencies do follow the dollar, but other times it's commodity prices. So there's a tug of war of both, and it's hard to make heads or tails of which way to go on any of them right now.
Yeah, we've been watching, again, Aussie dollar. We've been watching New Zealand dollar here as they have increased recently, again, with that tie recently to commodity prices. The roller coaster ride, though, is what we've been talking about as well. Also, Larry, you know, one thing that we've been discussing is with the elevated dollar and the euro currency weakened, rates on the rise, ultimately some of the pressures that the Fed's under relative to the FOMC. I guess I'm wondering, does the yield curve, the inversion there, and some of the, again, impact that has, or at least psychological impact that has, does this sort of accelerate things for the ECB entity, or does it kind of create a scenario where they can just sort of continue to kick the can down the road and remain a bit more accommodative?
Yeah, other than like sticker shock and I guess media squawk, didn't mean to rhyme there, but
doesn't really much.
No, I think you know what the central bankers are looking at, if they're looking at anything, would be like the 3-month bill rate versus a 10-year rate, and that's like what, you know, in the high 180s, a long way from inversion. Okay. Looking at the 210, it makes a lot of sense that it's close to inversion, given the fact that we're baking in, the market's baking in 2 50 basis point rate hikes, one in May, one in June, and a hike every month after that, 25 bips. And the long end of the curve is just going to stay within range. So it makes all the sense in the world. I don't think it's going to be pushing the ECB. In fact, the closer you are to Ukraine, I think the more trouble it's going to be to do something like that with the ECB. So I don't think that's something they're looking at right now.
Well, we've kind of been talking about how, well, up to this point, they've been a bit hands tied between a rock and a hard place based on proximity. Just kind of looking around here, not a lot of market reaction to these numbers. We've talked about rates, talked about the yield curve a little bit, some of the currencies, any of the other foreign currencies that we haven't covered that you have your eye on in terms of products our viewers should be watching?
Yeah, you know, you did mention this a little bit here, but the Australian dollar and the Canadian dollar, both of them versus the yen, I think, especially if you have any kind of reflationary ambition or think the market's going to bounce back, in my mind, that's a relatively cheap hedge for upside. I wouldn't necessarily buy Aussie or Canada versus the U.S. dollar, but versus the yen, I would definitely take a look if you have, you know, reflation ambitions or want to hedge against that.
We're looking at the futures here. If we could pull this chart, they have been rallying and recently finding support around that 78 even level, right back up to, well, those January end of January, middle of January highs that we saw. It'll be interesting to see if they can get up above the highs from fall of last year. Ultimately could open up the door for a retest of that upper extreme around the 8,300 level. Larry, lastly, Bitcoin, you know, a nice move up this week. Everybody was looking at the breakout. It attracted some attention. I think some of that was tied to, well, we've heard Russia is willing to accept Bitcoin for oil, but then again is, you know, some of the geopolitical tensions continue to come into play or get taken off the table. It seemed like Bitcoin sort of struggled to rally yesterday. Maybe it's sort of that inverse correlation to some of the geopolitical tensions right now. Again, there's if we see this battle or this war on Ukraine ongoing and lasting longer than many expected, ultimately, it seems like it opens up the door for Bitcoin to kind of get a couple steps forward. But if that resolves sooner rather than later, maybe that door closes.
Yeah, perhaps it does. And it's been a fascinating thing to watch, at least intraday, interweek price action. And I think me, along with perhaps a lot of other people are still trying to figure out what it's correlated to, or those correlations last for more than a week. Is it, like you said, is there inverse correlation to financial conditions or to war or a financial volatility indicator? That said, I think it's just right now, it's in a consolidation mode within a very wide range. And I think investors at large are trying to figure out what the correlation is and what will cause it to break down.
Or up, ultimately, it sounds like. Yes. Larry, appreciate you joining us here, and those correlations remain questions that many of us still have at this point. We'll continue to watch to try and figure it out, or at the very least watch it in terms of student price. Larry Shover, Chief Investment Officer at D. Alexander Capital, thanks for joining us and sharing part of your Wednesday with us here on the TD Ameritrade Network. We're going to take a quick break. Stay right where you are, though. When we come back, we've got my chart of the day. We'll take a look at some of the eco data headed our way. Alex Coffey is trading crude this morning with a paper money option strategy he's got his eye on and thinks we should as well. We're talking more futures after the short break. In just 2 minutes, we'll be back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
I'm Maria Schrader. Here are a few stories to watch before the bell. Five Below's fourth quarter this morning was mixed, with earnings per share of $2.49, beating expectations, and revenue of $996.33 million missing. Comp sales increased by 3.4%. For the full year, Five Below sees EPS in the range of $5.19 to $5.70, and revenue between $3.16 billion and $3.26 billion. Multiple analysts raised Lululemon's price target after the company reported a mixed fourth quarter yesterday. Baird lifted its target to $450 from $425 with an outperform rating, citing management's confident 2022 outlook. Citi also raised its target to $400 from $350 with a neutral rating, saying risk and reward are fairly balanced now. And JP Morgan downgraded Procter & Gamble to neutral from overweight and cut its price target to $165 from $181. The analyst says investors expect to see the company beat and raise on earnings, but this is now harder because of cost and currency headwinds. Therefore, she wants to take a pause and wait until the street becomes more realistic. This has been your TD Ameritrade Network Market Update. Now back to Futures with Ben Lichtenstein.
Thanks for the update, Maria. Welcome back to the Futures Show here on the TD Ameritrade Network. It's time for my chart of the day. Let's take a look at crude oil and some of the intraday volatility we've seen. We've been talking about how this market's been headline driven, and well, here's a pretty good visual reflection or representation of how, again, we've seen some intraday volatility, some sharp moves on headline news, but here you can see again the sell-off yesterday from 107.84 down to 98.44. That's a big move to the downside for crude, almost $10, not something you see every day. And take a look here, though, at the rally back. This is the 1 minute time frame. You can see, again, some of the, optimism tied to diplomatic resolution to the war on Ukraine yesterday weighing on crude. And then, again, some of that pushback from Russian negotiators, the Kremlin this morning, talking about how, well, they don't have a ceasefire. And as I mentioned at the top of the show, they said basically that ongoing negotiations are going to be necessary to continue. Now, I want to take a look here quickly at where things stand in terms of crude oil. Actually, let's take a look here at the 60-minute time frame. As you can see here, crude, after rallying up to 130.50 on the geopolitical tension, sold off to 93.53 and then back up to 116. So again, here's the move that we just looked at, this run up from 98 to 108, well, just shy of 108. But I want to point out that we're still kind of just in the middle of this range here that's been established. And as we take another step back, you're going to see crude oil again here continuing to honor that 50-day moving average. Two tests of it have held, and again, it lies down around 97.87 at this point. So $10 below where we're trading right now. Crude, a major focal point for many. It ties directly into that inflation, the inflation fears, concerns, and, well, some of the hurdles that it has forced us all to deal with in terms of prices at the pump. And, well, the ripple effect creates, again, higher prices across the board, it seems like. And again, with the negotiations ongoing, as we mentioned throughout the show, many would expect to see volatility continue to play out here. Let's get Alex Coffey's thoughts on crude oil, the negotiations, some of the intraday volatility we've seen. Alex is the co-host of Next Gen Investing here on the TD Ameritrade Network. Alex, welcome. Thanks for joining us. It looks like you have your eye on crude oil here as well. It's my chart of the day. We saw two tests now of that 50-day moving average that have held, and, well, for the most part, we've been above it since the beginning of January, a reflection of some of those geopolitical tensions and, well, expectations as these COVID concerns have diminished a little bit that we'd continue to see some demand.
Yeah, there's obviously a lot that's impacting the price of crude oil right now, Ben, as you note, but I think the market's also in quite an optimistic piece of time right now when you look at how well equity markets and other markets are performing. Volatility has come out substantially within this marketplace. That I think that we maybe got a little bit premature in terms of pricing in some optimism on the geopolitical front, but also maybe a little bit naive to assume that there's going to actually be any impact on crude oil, assuming that the conflict wanes down. I think, Ben, that it's more likely than not that even if there is some type of a ceasefire resolution, that the conflict is really just a symptom of a greater conflict between, kind of greater Eurasia and the Western world, the U.S. and its Western Europe allies. So I think that even if there is some type of ceasefire, Ben, there's a chance that these energy markets still face serious volatility for the time being. You have obviously a chart up there of the crude oil markets going back some time, but you can see that generally the market has moved higher for crude oil, and that continues to be the trend despite this near-term volatility that's being exacerbated by this geopolitical conflict.
You know, geopolitical conflict, underlying trend, well-defined underlying trend, as you mentioned, not only here in the crude, we're looking at that in terms of the purple line here, that is the WTI contract, but you can also see the candles are the ES and the well-defined trend environment there as well. You know, as you mentioned all of that, what came to mind, Alex, so as I started to think a little bit about how we had kind of heard from China a little bit in terms of where they stand on all this, but not much in terms of Saudi Arabia, the UAE. I mean, ultimately, we're going to get some information as far as OPEC. We're going to hear from them. Well, we're already getting some comments from them this morning, but we'll hear some more information from them tomorrow in terms of decision about production and increasing levels or not at this point. But it seems like they've been relatively quiet throughout this whole process and kind of a bit of a sideline, sort of an onlooker's vantage point.
Yeah, we got to keep in mind, Ben, that energy and the energy sector has been really struggling for much of the last decade coming into this time frame. I mean, we had crude oil prices at historic levels just as recent as 2020. Of course, we know what happened with some of those active months during that time as well. So you look at the volatility that this space has faced. they're probably welcoming some higher prices. I think they'd prefer some price stability. But, looking forward, ESG, things in that nature, there's not a lot of love for the energy space long term. And so there's a reluctance to bring more supply on in the near term and put this greater investment into something that you don't know where it stands going forward. I know that you're referring to the greater part of the world that is, of course, supplying much of the crude oil, but that, of course, ties into what goes on here domestically as well. As far as trading it, Ben, we know that implied volatility is still elevated, although off of its peaks. And you look at what's happened with crude oil bouncing back and forth, the idea of some type of an omnidirectional trade could be interesting for some. And the idea of what I was looking to do, Ben, was something in that camp. So something that could benefit from a move partially lower in prices over time, but really one that benefits from stabilizing prices or even higher moving prices. As I oftentimes consider, where am I comfortable taking risk? And in the case of what's going on in crude oil right now, I think that the velocity of risk appears to be to the upside, not to the downside. And so the strategy that I was looking at goes out to June. So this is a little bit over, I think, 48 days to expiration. So likely actually a May expiration, but settling to the June future. So they consider it the June expiration on the options chain and platform. But when you're looking at it, Ben, it actually would settle to that CLM22, which I believe is a couple dollars cheaper than the current active month. That if you just keyed in /CL, maybe it's trading around 105 on my last check. And so when you look at it, Ben, the strikes I was selecting were the 101, 198, creating what I would refer to as a skewed put butterfly. This consists of two option spreads smashed together. And this is what gives sort of this omnidirectional or possibly two-way directional aspects to this trade. And so best case scenario would be that it moved to 100, as that's where our debit spread would expand, but our credit spread would collapse. So you do this overall trade for a credit, though, and at the time I was looking at it around a 40-cent credit. So how crude oil options are priced, Ben, 40 cents actually corresponds to $400, as crude oil is $1,000 or 1,000 barrels of crude oil, and so each tick actually represents $10 as opposed to in equity options where that would represent $1. And so in this particular case, it does reduce our max risk slightly so that we'd have $600 in risk to the downside with a break even of 98.60 at expiration. But the most important thing here, Ben, is really not the exact strikes, not the exact expiration, but more the concept that I'm talking about, which is when you're looking at an investment or strategy or trade, is thinking about, what do I think may or may not happen? And then more importantly, where am I comfortable taking risk? So I don't know where the price of crude oil is going to go. I don't know if it's going to continue to be volatile, it's going to be stabilized, if it's going to move lower or move higher. But I have to come up, if I want to be involved in this market, where I'm comfortable taking risk, and then I can fit a strategy to what I think may or may not happen.
I like this, Alex, because for one, I'm always a better trader when I'm trading under more comfortable conditions, whether it means downsizing a little bit or having a little bit less risk out there ultimately. And with the volatility that we've been speaking to, and many expect it to continue, this is a good scenario where, again, you can sort of approach it from that angle, again, not necessarily fully exposing yourself, or from a more comfortable level. And again, I think many traders will attest to the fact that they do better under those conditions. Now, we were just looking at the price differential between the front month crude here as we are currently trading, again, the /CL contract, and ultimately the the June 2022 contract. So again, around 105, it is about $2.35 cheaper than where the current front month contract is right now, the continuous contract, basically the /CL. Alex, talk to us about a best case scenario for this trade.
Best case scenario, because in the strikes that I selected, the short strikes were the 100 strike, would be for on the day of expiration, if we were still involved in this trade, for crude oil to be perfectly pinning $100. But we got to be realistic, Ben, and in some cases that perfect scenario doesn't necessarily what happens. So really anything above all of our strikes we would be happy with, as we could keep our credit and move on.
Okay, Alex, we'll continue to watch this trade and look forward to seeing you back here. We'll watch crude oil prices as they digest some of the headline news and kind of balance here right now above the 93 and below the 130 level in this continuous contract. It looks like 121 to 90 for the June contract. But Again, a good look at crude oil this morning as it's a focal point for many as we get set for the cash open. Alex Coffey, you can check him out here throughout the day later on this afternoon. He's the co-host of Next Gen Investing here on the TD Ameritrade Network. That's it for us here for futures this morning. Still lots to come here, though, across the TD Ameritrade Network. Stick around. Up next, Oliver Rennick. Morning Trade Live is headed your way after this.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Good morning and welcome to Morning Trade Live. It is Wednesday. It's the end of the quarter. It's March 30th. We're almost done. 3 months in, and it has been a wild ride. Over the last couple weeks, it's been straight up. The roller coaster that goes right vertical. Does it drop you back down? Or do we plateau, or do we just keep on going? Seems like this morning we've got a little bit of a pushback here. I think bears have to do something today or else run the risk of just getting completely run over. We've got a couple days left this week that includes an employment print on Friday. There's a lot of Fed speak, plenty of news flow here on the macro side that could bring up that subject of rate hikes and inflation again. The thing that still is the most attributable to the downside over the last 5 months going here since the market peaked in November. But bulls are making a strong case that perhaps that Fed path is not going to derail things after all. We did bottom March 15th on that first hike, and we just keep ripping. A little bit of a fade from some of the recent strength, but it's not too deep of a sell-off here. Not much at all, about 0.5%. Pretty easy to recover that the way we've been opening up and just really ripping and holding strength throughout the day. It's been a really impressive rally. And we did get some explanation for perhaps why yesterday with the headline that Russia will draw down military activity in Kiev, but also an important message from the White House too that better to see the evidence than just hear it and assume it's the case. So we're still looking for a real confirmation and developments from the conversations happening between Ukraine and Russia. That being said, the market for now a couple weeks has been giving us some hints that perhaps the lack of escalation in that conflict has been processed by markets and received very well by markets. Obviously, crude oil coming off and gold coming off too. Those have been the key assets to watch as the market does appear to give some signs of relief and reprieve. This morning we've got the opposite now, both up. So generally speaking, even if it's not something specific to Russia necessarily, the idea of crude being a risk point is symbolic of inflation as our main risk. So lately, generally, we've had days that are weak for equities when crude is really strong. I think generally just putting the whole commodity complex into one risk point as inflation and what that means for the Fed pushing back on it. That's been the story now for months, obviously. And for crude oil, even with all the craziness around Russia, you can just draw a straight, simple trend line connecting the lows that really tells us how much conviction there is behind the inflation story and the way investors want to position for this year. Crude oil up 3.5% this morning, and yesterday also a pretty big sell-off in crude that caught itself at $100. I think this interesting candle yesterday does tell us that we should be viewing this as a long-term trend that perhaps doesn't need additional conflict from Ukraine to keep it going. Maybe it means that we don't have 8-10% moves higher. We'll talk about it a little bit more with Ben, but this chart still is one of the most important out there. And even with all the volatility upside and downside in crude, these big swings, you could just extract all of that and see the broad trend that keeps going with inflation. Don't forget, the Fed's meeting in May. That's the next potential for the rate hike. So we've got some time between now and then, and it's going to include the hottest inflation print we've had yet. We are still seeing some pretty crazy inflation numbers around the world and hearing some pretty wild commentary from the RH CEO last night, Restoration Hardware. We're going to talk about that this morning too. Pretty intense conference call on their earnings, talking about inflation and the major risks that that team sees going forward this year. All right, we'll get to the stocks and all that. Now, look at what's happening in equities, in the NASDAQ in particular, as the broad index and its strength, 17% off the lows. Just a total face ripper of a rally, but some interesting data digging that's been going around. If you look at the number of times we've had this type of sharp move in the span of time that it's taken, 15 days, okay? Yesterday, a 14-day rally of this size really only happens on a few occasions in history, and many of them have been around periods of downtrending markets. So is this the bear market rally? Certainly, for the NASDAQ, technically still is. We got to get above 20% off the lows until we're back in the bull market. That's the way the technical definitions work as we tick down and hit that 20%. But for traders in the meantime, if you're not too worried about the titles and all that stuff, all you want to know is what happens next. So at 15,200 here, we're basically right back to those February highs, which are the same as the late Jan highs. Obviously, the early Jan highs are way back here, around 16,000 and above, but this is an interesting area. Once we got through that 14,500, we had a pretty quick rip. That was basically the move that I expected. If we did breach that, then now there's another resistance level that some technicians are watching, basically right around now. Again, bears, I think, have to really do something here. If not today, then in the next couple days, at least this week with employment. If we can get through all of the data and that big employment print and still have bulls winning out here, that means we're looking at taking out previous highs and inching towards bull market territory off the lows. That's a very different vibe that then suggests we probably need to go back Lulu's pretty high end too, but still generally affordable. That they are still cranking, and brand power goes a long way.
It certainly does. Lululemon up about 7% in pre-market trading. The athleisure company reported better than expected earnings and an upbeat outlook. Revenue came in a little bit disappointing by some accounts, but investors clearly focused on those better than expected earnings and that upbeat forecast. Let's run through the numbers. EPS came in at $3.37. That's 10 cents ahead of estimates. Meanwhile, revenue came in at $2.13 billion. That represents growth of more than 20%. Comp store sales rose 22% in the quarter. Now, in terms of outlook, Lululemon expecting Q1 revenue to grow to 24 to 26% in the range of $1.53 to $1.55 billion, on EPS in a range of $1.38 to $1.43. Meanwhile, for the full year, revenue is expected to grow 20 to 22% in the range of $7.49 to $7.62 billion, on EPS of $9.15 to $9.35. That's for the full year. Lululemon also announcing a $1 billion share buyback program. And Oliver, in terms of prices, as if yoga pants aren't expensive enough there, Lululemon said it could offset input cost increases with selective price hikes for its athletic and leisure apparel. Now,
gonna be getting up there. Ain't cheap.
I know, as if $100 wasn't enough. But in terms of analyst action, Credit Suisse maintained its outperform rating following these results, but cut its price target to $450. Lululemon currently trading at $343, so quite a bit of upside there. Morgan Stanley incrementally positive on Lululemon after the results. Analysts there suggest top-line growth could remain higher for longer. They're still revising estimates, but they're maintaining a hold rating and $300 or equal weight rating, but has a $300 price target that wasn't adjusted, so obviously quite a bit lower than where it's currently trading. Baird raising its price target to $450 from $425, keeping an outperform. And Citi boosting its price target to $400 from $350, kept a neutral rating on the share. Analysts there believe that the strength of the business is due in part to better stock inventory, as the company is shifting to use air freight to secure inventory, but the analyst there thinks that could weigh on gross margins in the near term. So as such, believes Lululemon risk reward is fairly balanced at current levels. Okay. So neutral rating there. So quite a bit of activity, but looks like it's going to be a big winner today, up 6.7% with about 15 minutes to go before the opening bell.
I mean, just a huge beat with the outlook for revenue. But still going to hike prices anyway, it seems like. So, all right, they're going to get expensive, those pants. Already above my budget, but I guess it's not my priority. All right, thanks, guys.
You're spending all your money at Petco.
Caroline Woods and Alex Coffey. Let's get Ben in here. Let's talk some charts. Ben, all right, so we've got now crude oil. Let's go there because tomorrow we've got OPEC, and that's a pretty big meeting, I think.
It is a big meeting, Oliver. I'm not sure if we should expect much in terms of change from production for OPEC, though, because they actually already came out and they said that they see a first quarter stock, a build of 600 barrels per day from 1 million barrels per day earlier projected. So again, I'm not sure if they say basically that they don't see a lot of increased production coming into play, so the build will be less, or if they think that they'll see increased demand. We'll probably get a little bit more information from OPEC. But I think what's playing out here is really interesting in crude oil right now. We've got some really well-defined upper and lower extremes right now as we see kind of the chop type trade, the burn and churn sort of overlapping and rotational price activity.
They came in quick to buy at 100 yesterday.
No question. There was some run up there and prices got supported. And we'll get into why in just a second. But I just want to point to the difference in terms of overlapping and rotational price activity relative to a really well-defined trend environment where you're seeing higher highs and higher lows. So this is kind of noisy. This is high conviction. So
love that. Yep.
What we're seeing here now, again, in terms of, we could just zoom in on the more intraday chart that I have a look at the 1 minute for us because we saw some noise yesterday, Oliver. Okay. Initial sell-off here in reaction to, there you can see on the left side of the screen, comments coming from some of the Russian negotiators basically talking about how talks have been constructive. And then throughout the day, I think a little bit more level heads kind of prevailed at this point. We heard back from Ukraine negotiators that basically kind of said, look, don't forget, there's been no ceasefire established at this point, and we continue to see shelling, even though they talked about pulling some of the troops back.
And there was a caveat to this. It's pulling the troops back while they have the discussions, right? It's not like, hey, we're done here.
That's right. And there's also skeptics that point to how the troops are probably just kind of repositioning and maybe even just getting supplied at this point. So again, crude rallied back. So here being the point that we're just so headline driven right now. So expect continued volatility here as these talks continue. Again, they actually cut them short right now. So I think it was 2 or 3 day talks that got cut short after one day. But look again, crude rallying back here. And then, so the point being here that we're going to see some intraday volatility. We're going to see some continued gyrations as far as price, but we have well-defined upper and lower extremes right now. 130 being the upper extreme down to 92-ish, we'll call it the lower extreme. So we can help kind of sort out noise between something more significant or a change in sentiment at this point, but still well-defined trend environment to the upside. And now what we're seeing is that consolidation sort of accepting these upper level prices, albeit a very wide range.
Okay, so if crude has held its uptrend, even despite some of that back and forth, the rotational trading, that has been quite a battle here, but ultimately, I think bull's still winning out, right? The trend is in place.
No question. Yeah. And to your point a second ago, in terms of short-lived below $100, that's what you see when you see bulls in charge. Again, if you're positioned with the trend as a trader, pullbacks against you spend very little time. That's why it's sort of, the saying goes, the trend is your friend in theory for multiple different reasons.
And that's where I wonder, okay, well then if the crude trend is still upward, then how do we describe which other trends are going to be the winning trends, right? For the stock market and the NASDAQ, we're trying to figure out if this is a bounce or if this is the beginning of a new trend, right? We're thinking also in terms of risk assets, whether or not Bitcoin has been establishing that trend. That's a chart you watch too. We haven't hit yet this morning. Down a little bit, risk off. Generally what we see works in the same way as stocks for the most part. But it did do something different than stocks, which was putting in the higher lows. It got that momentum earlier. So what are you looking at here? I mean, do we chalk this up to noise too? Or when do we say that there is real reversal? Because I think a lot of stock bulls want to see this go too and signal that that risk on is back.
Yeah, in terms of that risk on, risk off sentiment, I think there's a few factors at play here in terms of Bitcoin. First, in terms of price, it's kind of an opposite story of what we were just talking about with crude oil, where crude's rallied and then kind of consolidating at these upper levels. Bitcoin, after coming off the last year November all-time highs of around 69,000, it's kind of been consolidating at this lower level. But similarly, what we were talking about with crude in terms of a breakout, we're getting one here. The breakout to the upside, I think, more tied to those talks about Russia accepting Bitcoin in exchange for energy prices. But then again, with some of those geopolitical tensions coming back into play, you can see how follow-through is a little bit limited at this point. So that's what we need to be watching for. It's not as significant to break out of a range as it is to see follow-through in price and time spent above or below it. That'll be what we're watching for in terms of Bitcoin.
Okay, bingo. So we're kind of back in the middle of that range. 30 to 60, kind of roughly. We're now at 48.
Bigger picture range.
Exactly. Okay. All right. So we got halfway there, but maybe not the confirmation of that big breakout just yet. Okay. Risk assets stalling a little bit here today. Let's talk some more about the economic situation, the inflation problem the Fed is trying to deal with, all ahead of employment on Friday. That's the context here we have to remember as GDP comes in a little bit shy and the consumer slows somewhat. 10 minutes till the opening bell. Be right back.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Our third look at GDP comes in a little bit below expectations, and consumer spending also a little bit shy. So do we have problems on our hands? Let's talk about the big picture before the bell rings with Stephen Moore joining us, senior economist at Freedom Works. Stephen, welcome to the show. Good morning. Thank you for being here.
Good morning.
Okay, so right now we're at a moment where the Fed is ready to embark on a tightening path, and markets have rallied right in the face of it. Does it make sense to you, Stephen?
So a couple of things. First of all, I think you just reported, what was that ADP jobs report? It was like 400,000.
Uh-huh.
That's a good number. That's a very positive number. And so, that makes me think that, for people who want work out there, the jobs are out there, no question about it. So the jobs market is very strong right now. The problem as I see it is we just don't have this inflation tiger by the tail yet, and it's getting worse, not better. And this is causing real wages for workers to decline. And so when you've got 8-9% inflation and you got wages rising by 5% or so, workers are losing money in terms of purchasing power. So I think that's the biggest problem on the horizon right now. I don't think spending hundreds of billions of dollars more in terms of federal spending, and I don't think another massive tax increase makes a lot of sense right now. I do think the Fed has been behind the curve for the last 9 months, and I'm not Monday morning quarterbacking here. I've been saying this for 9 months. The Fed has got to get in front of this inflation problem, and I think they're late. And the longer it takes for them to bring this inflation down, the more painful it will be.
Stephen, we're thinking about 50 basis points for the next hike. It seems like all the Fed governors are warming us up for that. Instead of the 25 that a couple months ago might have been priced in for May, now we're at 50. If we need 50 instead of 25, how do we know we don't need 100 instead of 50, or 50 and then another 50? I mean, if this is to combat inflation, why not press the pedal to the gas right now to the floor when we know inflation's going to get our worst print yet?
Good point. That's a good question. I don't have a good answer to it, but I think you asked the right question. Why don't we just rip the Band-Aid off, right? I don't see, a quarter percentage point increase that we've had is pretty weak, given that we have this high inflation rate. There are a number of economists who I respect who think that the inflation rate could go to 12 or 13 or 14%. So I think the Fed is late. I think that they've been impotent in terms of dealing with this. But we also have to look. It's partly the Fed. It's partly Washington. These trillions of dollars of spending that have been financed by printing money has certainly accelerated the inflation problem.
Stephen, is the rate hike paradigm that we're going to be in the correct solution? It seems like kind of the only lever they have to pull, and President Biden certainly wants them to pull it, as he's put the inflation-fighting responsibility on Powell's shoulders. But does it lessen demand right at a time where it might be softening already? If do you want to be behind the ball? If you are behind the ball, should you even do it at all? I mean, right now, can we withstand it?
Well, it's a great point. I agree with what you just said.